This is part second video of a conceptual and regulatory framework for financial reporting. In part first, we have already discussed about what's financial statements, a need of financial statement, and about a brief discussion of GAAP, that is generally accepted accounting principle, and what's the difference between AS, that is accounting standards, and Ind AS, IAS, and IFRS. In this video, I would like to discuss about what exactly the conceptual and regulatory framework means. Okay, conceptual and regulatory framework. Two types of framework available. That is, one is conceptual and second one is regulatory. Okay, let's focus on conceptual framework only. Accounting needs a conceptual framework because a framework, it is the foundation of accounting standards. That is, a conceptual framework acts as a constitution for the standard setting process. That is, it's related to the concepts that are to be covered in financial reporting. So we can say concepts are the groundwork, the basis, the foundation upon which the superstructure of standards can be created. In other words, we can say lack of a conceptual framework may mean that certain critical issues are not addressed. For example, until recently there was no definition of basic terms such as asset or liability in any accounting standard. Today, transactions becoming more complex, businesses become more sophisticated. So a conceptual framework, it helps the preparers and auditors of accounts to deal with transactions which are not the subject of an accounting standard. Hence, ultimately, a conceptual framework strengthens the credibility of financial reporting and accounting profession. Without a conceptual framework, a consistent approach to standard setting cannot be achieved. See this chart. I'm discussing only conceptual framework. It consists of qualitative characteristics of financial information. That is the first one. And second one, elements of financial statements. And thirdly, recognition of elements of financial statements. These are the important contents included in a conceptual framework. In this video, I would like to take only qualitative characteristics of financial information. Qualitative characteristics are the attributes that make information provided in financial statements useful to others. Okay, see this chart. You can read it yourself, you can understand. The framework splits qualitative characteristics into two categories. That is, fundamental qualitative characteristics and enhancing qualitative characteristics. Fundamental qualitative characteristics include relevance and faithful representation, and enhancing qualitative characteristics include comparability, verifiability, timeliness, and understandability. In case of conceptual framework, the framework has given us certain quality. That is, if certain characteristics are present in a financial statement, we can say it's a good financial statement. Then what do you mean by fundamental qualitative characteristics? These are the basic ones. These are the fundamental ones. If these qualities are absent, financial information is not good. These qualities will help us to differentiate useful information from not useful information. So the fundamental qualities bifurcated into relevance and faithful representation. Then relevance. What do you mean by relevance? We can say an information is relevant if it helps decision making. That is, if it has the ability to influence the economic decisions of users, we can say the information is relevant. Who are the users of financial statement? It may be users, maybe management, suppliers and creditors, lenders, employees, trade unions, customers, government and their agencies. Okay. And of course, public, security analysts and credit rating agencies and researchers. All are users of financial statement. Okay. So if an information is provided in time to influence the decisions taken by the users, we can say the information is relevant. One more point is there, that is the information that is relevant has predictive or confirmatory value. Here predictive value enables users to evaluate or assess past, present or future events. And what is confirmatory value? It helps users to confirm or correct past evaluations and assessments. That is what is meant by relevance. Next is faithful representation. To be perfectly faithful representation, financial information would possess the following characteristics. First one, completeness. Secondly, neutrality. Third one, free from error. Completeness means to be understandable, information must contain all the necessary descriptions and explanations. And neutrality, that is information must be neutral, that is free from bias. And lastly, free from error. That is a material error or an omission can cause the financial statement to be false or misleading. Next is enhancing qualitative characteristics. Here we look for further qualities. That is, now we have useful information, right? From these useful information, you can find out more useful and less useful information. Okay. So, here we focus on 4 qualities, that is comparability, verifiability, timeliness and understandability. First one, comparability. Here users must be able to compare the financial statements of an entity over time. For what? To identify trends in the financial position and performance. Similarly, users must be able to compare the financial statements of different entities to evaluate their relative financial performance and financial position. Next is verifiability. Verification can be direct or indirect. Direct verification means verifying an amount through direct observation. For example, by counting cash. Indirect verification means checking the inputs to a model, formula, or other technique and recalculating the outputs using the same methodology. For example, recalculating inventory amounts using the same cost flow assumptions such as first in first out method. Next is timeliness. Timeliness means having information available to decision makers in time. If we present the right kind of information in right time, so it must be capable of influencing their decisions. Okay. Generally, the older the information is, the less useful it becomes. Next is understandability. Understandability depends on the way in which information is presented, and secondly, it depends on the capability of users. So it is assumed that users have a reasonable knowledge of business and economic activities. Secondly, they are willing to study the information provided with reasonable diligence. So we can say it must be understandable for people with ordinary diligence or people with a reasonable knowledge of business, accounting and economics. Okay. So here we have completed one section of this conceptual framework, that is qualitative characteristics of financial statements. Now we have 2 more sections in conceptual and regulatory framework, that is elements of financial statement, secondly recognition and measurement. We would be discussing those things in another video. Okay, thank you for watching.